You can beat about 90% of professional investors, not by being smarter, by doing almost nothing. Over the last 15 years, roughly 9 out of 10 professionally managed large company funds failed to beat the plain S&P 500 index. The people with the Bloomberg terminals, the research teams, the very nice suits, beaten by a list. Today, what an index fund actually is, why the boring math wins, and exactly how to start with $100. Quick rules. This is education, not financial advice. And no, nobody is sponsoring this. First, the thing itself. An index fund isn't a company, or a bet, or a strategy. It's a list. The S&P 500 is a list of the 500 biggest public companies in America. An index fund just buys the list. One share of the fund makes you a part owner of all of them. The phone in your pocket, the search engine you use today, the store you drove past. You own a slice of each. Put in $100 and it gets sliced across the entire list, automatically. Which means you're no longer betting on a company. You're betting that American business, as a whole, keeps compounding. That's the entire thesis. And when a company on the list dies, it falls off the list. A new one climbs on. Your fund never even calls you about it. So why does the list beat the professionals? 3 boring reasons. Reason 1, costs. A typical index fund charges about 0.03 of 1% a year. Active funds routinely charge 1%, 30 times more, and they have to beat the market by that much just to tie. Run it forward. $500 a month, 30 years, 7%. The low-cost fund lands at about $606,000. The same performance, minus a 1% fee, about $502,000. The fee quietly ate $104,000. For that price, the manager should mow your lawn. Reason 2, the misses. To beat the index, you have to outpick it, and the handful of stocks driving most of the market's gains are brutally hard to hold through their worst days. Reason 3, taxes and turnover. All that buying and selling has a bill attached. The list barely trades. Add it up, and the scoreboard makes sense. Over 15 years, about 90% of the pros lose to the thing that isn't even trying. Now the part everyone overcomplicates. Actually starting. 4 decisions, in order. Decision 1, the broker. Any of the big zero-commission brokerages works. The differences at this level are cosmetic. Pick one. Don't date all of them. Decision 2, the account. In the U.S., if it's for retirement, a Roth IRA is usually the first stop. Taxed money in, tax-free growth out. Might need it sooner? A plain taxable brokerage account is fine. Decision 3, the fund. You're looking for the words S&P 500 Index or Total Stock Market Index and an expense ratio near 0.03%. If a fund needs a brochure to explain itself, it's not this. Decision 4, the only one that actually matters. Automation. Set an automatic monthly buy, any amount, the same day your paycheck lands. And yes, $100 is enough. Most brokers sell fractional shares, so the price of one share is irrelevant. Notice what's not on the list. Timing, forecasts, watching the news. Last Wednesday's audit found the money. This parks it. Monday's math does the rest. Honesty segment. 3 real objections. Isn't this just betting on a handful of giant tech companies? Partly yes. The list is weighted by size and the top 10 are a big slice. That's the price of owning winners. They get big. If it worries you, total market funds spread wider. What if it crashes right after I start? It might. Friday's video watched a machine trade straight through the ugliness. The plan survives crashes for one reason. The deposits keep landing. Crashes, remember, are discounts. It's boring. Correct. That's the feature. Excitement in investing is usually a fee in disguise. And the real risk nobody mentions, quitting. This math only fails when you leave in the middle of it. So the list beats the pros about 9 times out of 10 because it's cheaper, calmer, and never has a bad quarter of judgment. One broker, one account, one boring fund, one automatic transfer. That is the entire setup. $100 starts the clock, and Monday's chart showed you exactly what the clock is worth. Wednesday, I build an AI bookkeeper for a side business in one evening. It's unreasonably satisfying. Education, not advice. Talk to a licensed professional about your situation. I ran the numbers. You just have to start the clock.